Okay, so still hanging with employees, but now going into other aspects of benefits that we have. First off is accidental and health insurance. Now, when we actually engage into this, taxpayers can exclude from income the total amount received for payment of medical care and payment for a loss or use of a member or function of the body. That's actually good to know. Again, accident and health. Now, when it deals with an HSA or one of those, which we'll talk about, those we need to make sure we spend everything, or we actually will be taxable for some income dealing with those health plans. But for health insurance and accidental, we're pretty much good. Now, premiums paid by employer for employees' Medicare are excluded from income. This is our cafeteria plans or any other fringe benefit that deals with paying the premium for us. So we don't really have to worry really too much about insurance. Again, most of the income is excluded. That's nice. How about our next one? Meals and lodging. Alright, so this one's a little tricky. Now we're going to learn that we're only allowed to deduct so much depending on the situation. But usually meals and lodging provided by an employer are generally excluded from income if the following tests are met. Okay? Meals are provided by the employer on premise during working hours because employees must be available for emergency calls or is limited to short meal periods. Again, if the employer provides it, and it has to be on premises. Now, on a job site, well, that job site would pretty much can be premises. If I take you out to McDonald's, that actually does not, that violates kind of this. It has to be actually food coming in. It's very technical that way. But what we can do, under the Tax Cut and Jobs Act, our good old friend TCJA, we can actually deduct 50% of the cost of these meals by the employer. Same thing goes with our own business. If I have to pay for meals for employees, I get 50% of the cost. That's nice. Now, lodging as itself is provided by employer on premises, there's the key again, and must be accepted as a requirement for employment. Now, this is usually maybe for, let's see, a good example probably is an apartment manager. Property managers typically have to live on premises and actually get it provided. So, we can again exclude it, exclude that income. Same thing with clergy members that have to live on church grounds. It adds a little bit of that exclusion. But like for hotels, if I'm getting reimbursed for hotel cost, stuff like that, that's considered almost traveling. So those I actually have to recognize as income. Yay. But the key thing is, again, it has to be provided on premises for meals so that we can be available for emergency calls or limited to short meal periods. So again, getting donuts, we don't have to put that as income, and the employer gets to take 50% of it. 50% of that cost. Not too bad. Again, as a tax account, Key thing that I'm going to always ask, was it provided on premises? Alright, told you we'll get to these fancy accounts. This one is the first one, FSA. So, good old employee fringe benefits. First one again is the flexible spending accounts. And these are employer-sponsored plans allowing employees to set aside pre-tax, key, pre-tax money for various expenses. This is why if we don't cover it, it can be taxable. Now, the dependent care flexible spending accounts allow up to $5,000 each year to be set aside to cover the cost of caring for a dependent child or aging parent. So again, you can set aside only $5,000. If you set aside any more, you can actually receive penalties and be taxable for the extra. Healthcare FSAs, so different ones, we have dependent care and healthcare, allow up to $2,750 each year to be set aside to cover medical expenses, such as dental work, optical care, prescription costs, and health insurance co-payments. These FSAs are nice. Flexible spending accounts. Now, this can result in significant tax savings. It's like, why? Well, remember this. This is pre-tax money. Okay? Pre-tax money is going into this FSA. So that means less money from your salary being taxed, which saves you tax money. Now again, these FSAs have a catch. They basically have a use it or lose it provision to it. Okay? If amounts are left in FSA after December 31st, the employee will lose them. For healthcare FSAs, employers have the option to allow $550 of the unused balance to carry over to the next year, or to offer a 2.5-month grace period after year end to incur additional medical expenses before the employee loses the balance in the account. Yeah. So you can lose that money. That's the bad thing, because again, it's only for medical use. Same thing goes with HSAs. Now, for FSAs that permit a grace period, we do have the temporary COVID-19 provision that was passed that will allow a grace period to be extended to December 30th of 2020. That's fine. We have a little hiccups there with COVID-19 changing just a tiny bit of the laws. I'm okay with that. Provides good benefits. But, again, I haven't heard anything new about this. So, we do have that 2.5-month grace period here in 2021. Alright. Now, I'm surprised they did not put HSA. We're going to probably end up talking about that later, because all that is a health savings account. And that one you actually will have to use all the medical, or it will be considered income and you will be taxed on it. And that one can leave some good taxes going on. That's scary. Anyway, we may exclude certain fringe benefits from gross income, such as the following. Employer paid premiums for group term life insurance. up to 50,000. Once it's over there, we must include anything above that limit as income. It's highly doubtful, unless you've got a really great company, that you'll hit that 50,000 mark. That's why they have that limit. Education assistant plans, up to 5,250. Again, once it reaches the limit, then it'll be part of income, and they will have to state that. No additional cost services. Okay. With very few exceptions, mostly, again, we won't see a lot of the exceptions going on. I just want to get y'all that brief knowledge. Qualified employee discounts. Now, I think this one is if it's over 10%, it may end up being part of income. So we have to watch out, or if it's like over a certain threshold. Working condition fringe benefits. Again, excludable only if taxpayer can deduct items on their own as employees. De minimis fringe benefits. Basically small benefits that would be impractical to account for. I honestly do not... What a good example on these. Maybe a reimbursement for stamps, or something very small, insignificant, that people, even the IRS be like going, whatever. Hey, a tuition reduction. Nice. The value of membership to on-site athletic facilities. Again, another on-site item. That's also cool. So that's for your trainers. Trainers don't have to pay for, basically report the value of the membership. And then retirement planning services. Now, we do have to report retirement, but if it's just one of those retirement planning or financial planners, no, we can exclude those. Okay? So, Grassley put, here's a poll. Okay, so we talked all about fringe benefits. How about this? Christina and Milo have 2 children, ages 3 and 6. When they are making their annual budget, they determine that they will have an extra $2,000 over the course of the year. That's awesome to be able to make a budget like that. They are considering 3 options. Christina's employer allows her to make contributions to an FSA. They are trying to decide if they should put the money in a healthcare FSA or a dependent care FSA. Or perhaps they should start an education assistant plan. That's a good one there. For their children. What should they put their extra money? Again, this is y'all guys' poll. Just what you think. Because to be honest, there is no correct answer here. Again, you can put the money whichever way you want. So FSAs do have that use it or lose it policy, which we talked about, and they would be riskier choices if they are not certain that they would spend all that money by the deadline. But if they are sure to have over $2,000 in either healthcare or dependent care expenses, it might make more sense to do these FSAs because that pre-tax dollars. That is such a key. That pre-tax dollars. This will also allow them to essentially move what they have allocated for these items to a different line item on their budget, freeing up that money to put elsewhere. In other words, it might not actually use that extra money at all, which is cool. The educational assistant plan, though, again, strictly for educational purposes, tuition and books and maybe housing for the child, mostly for like private schools and college. It's really what it really boils down to when we look at an educational assistant plan. It's nice how they put that in the poll. But their ages 3 and 6. Nice. Okay, so that concludes this part where we discuss about fringe benefits, the mills, and accidental health and health insurance. Not too bad. So, again, a lot of information coming to you as we keep moving forward.